Alright friends, once you have completed writing this entire calculation, let us move ahead and take up the next example, that will be example 2. This is a follow-up example with respect to example 1. It states, in addition to quantitative information in example 1, consider following additional information. 200 units of beginning inventory was at cost of $25 per unit. Purchase of 1,300 units during the year was at cost of $30 per unit. Sales of 1,400 units during the year was at $50 per unit. 100 units of ending inventory are to be measured using FIFO method. Now I'll explain you what is FIFO method in brief. What will be the effect on income statement and balance sheet with respect to the value of the inventory, and what will be the gross profit. So basically, in this particular example, which itself is a follow-up of the previous example, the sale price and cost details have been given to you. You just need to now bring the sales and cost figures into picture. Quantitative information remains as it is. We need to consider that as well. Now, what is this FIFO method? Basically, the whole topic of inventory, we are going to have a separate set of lectures on inventory topic. There we are going to learn various methods of inventory valuation. But while handling examples like this, if we are dealing with some specific method over here, we will definitely discuss it out over here itself. So let me do one thing. Let me first explain to you how do you begin with your solution. Look at your solution first. In your income statement, now you make a double column presentation. One is the main column, one will be the inner column. You record your sales first of all. So sales will be 1,400 units at $50 per unit. That will be $70,000. That is your sales revenue. Now coming to the cost of goods sold, you first start with your beginning inventory. Beginning inventory, quantity wise, there were 200 units. Each unit is at a cost of $25 per unit. So $25 multiplied by 200 units will give you $5,000 as the value of your opening inventory. You make purchases of 1,300 units, but now cost is also given. 1,300 units have been purchased for $30 per unit. So your cost becomes $39,000. So your cost of goods available for sale will be $5,000 of opening inventory plus $39,000 of current purchases. That will be your cost of goods available for sale. We need to subtract the closing inventory to arrive at the cost of goods sold, because you should not forget one thing, that in total what is available for sale represents 1,500 units. What is actually sold is only 1,400 units. So we have to consider the cost of goods sold with respect to those 1,400 units only. Now the question is, how do I measure the value of those units which are lying in stock? There may be various methods of inventory valuation. The example over here is emphasizing FIFO method. FIFO. It indicates first in, first out, which is a very fundamental method of inventory valuation. First in, first out. So what was purchased first is sold first. First in, first out. What was purchased first is sold first. So whatever remains is out of the later acquisition. So look at one thing. This is the beginning inventory. It was at $25 per unit, and this is the new purchases made at $30 per unit. Simple logic is, if you are using FIFO method, this quantity, that is 200 units, would have sold first, because your assumption is first in, first out. What was there earlier would have been sold earlier. So you would have first sold these 200 units and then the remainder out of this. So whatever be the closing inventory or inventory at the end of the period will be out of these 1,300 units only, that will be measured at $30 per unit. As a result, from the total cost of goods available for sale, I will subtract ending inventory of 100 units at $30 per unit. So the ending inventory value comes to $3,000. $44,000 was the cost of goods available for sale, of which $3,000 worth of goods remained unsold. So what was sold would have the balance cost of $44,000 minus $3,000, that will be $41,000. That becomes the cost of goods sold, and therefore your gross profit will be sales minus cost of goods sold, that comes to $29,000. So please write up this entire thing as your solution to example 2, and then we move ahead. Alright friends, after completing this example, let us move ahead and take up the next example, which over here I have taken as example 5. So first of all, you might be wondering that what happens to the other examples in between. So all the examples that I want, I have covered up these examples definitely. So what I have done is, certain examples I have included along with the initial discussion, and certain examples, the discussion of these examples I have included along with the practice sessions. So all the examples will be discussed, don't worry on that. So right now you focus on the example in hand, that is example number 5. It says the firm had 40 units of inventory at the start of the year at a total cost of $800. So now this example is giving you quantity as well as cost details. It purchased a further 160 units during the year as given below. Now 160 units of purchases, they have split into 4 different lots of purchase, that is purchase 1, purchase 2, purchase 3, purchase 4. While you are reading an example, first thing that you must make sure is 160 units you should be able to reconcile. So 50 units, 40 units, 30 units, 40 units. If we take aggregate of these 4, it is definitely matching with 160 units, correct? 50 plus 40 plus 30 plus 40 will give you exactly 160 units. So there were 40 units already as beginning inventory, fresh purchases made in 4 different lots, it was 160 units. So 40 units plus 160 units makes it as 200 units in total. The firm made a sale of 150 units during the year. So the total quantity available for sale was 200 units. The firm made a sale of 150 units out of this, and 50 units will be obviously lying as closing inventory or ending inventory by end of the period. It says determine the cost of 50 units of ending inventory that are unsold at the end as per the following methods. Number 1, it is weighted average cost method. Number 2, specific identification method. If these units, that is if these 50 units relate to purchase 1, and third one is FIFO method, that is first in first out method. So in the previous example we have already considered how to apply first in first out method. Specific identification method is actually very simple, because here you will be informed that the inventory that is left over is out of which lot of purchase. Simply value the inventory as per the specific identified purchase lot. That means here 50 units relate to purchase 1, and how many units did you make purchase in purchase 1? It was 50 units. So 50 units multiplied by $22, that will give you what? $1,100. That is the answer for the second part of this example. Straight and simple. FIFO method you have already learnt. So under FIFO method what will happen? 50 units will be as per FIFO. So what has been purchased first will be sold first. So what remains is out of the later purchases. So 50 units of unsold inventory by end of the year will be out of the later purchase. So we start with the purchase 4, but that was only 40 units. That means 40 units pertain to purchase 4. So balance 10 units must pertain to purchase 3. So if I have to find the value of inventory as per FIFO method, I will take 10 units from purchase 3, apply at $28 per unit, and 40 units from purchase 4, apply at $30 per unit. That gives me the answer for FIFO method. What is something now to be understood very well is the application of weighted average cost method. What I'll do is, I'll not speak on that right away. I will explain it to you along with the calculations that I have to show. So please concentrate on the screen right now. So in the solution to the example, what you will first do is, you first write up the inventory details. So purchase 1 was 50 units at $22 each, which is now valued in total cost as $1,100. Similarly, purchase 2, 40 units at $25 each is $1,000. Purchase 3, 30 units at $28 each, it will be $840. Purchase 4, 40 units at $30 each will be $1,200. The total cost of purchase of 160 units is coming to $4,140, and to this we add cost of beginning inventory, that is 40 units, which is informed to you as $800. So cost of goods available for sale, that is in total 200 units, will be $4,940. Now what you need to understand is, you have $4,940 as the total cost of the 200 units available for sale. So when we say weighted average cost method, the idea is very simple. $4,940 is the cost of 200 units. So you divide $4,940 by 200 units, you will be getting the weighted average cost per unit. That weighted average cost, when you multiply with the closing inventory or ending inventory quantity, you will be getting the cost of the closing stock or closing inventory or ending inventory at weighted average cost method. So let me show you how to do this. The ending inventory at weighted average cost will be $4,940 divided by 200 units into 50 units, and that comes to proportionately $1,235. So please write up this working and then I take you ahead. Alright friends, once you have completed writing this much, let us continue further with the other two methods. We begin with specific identification method. I have explained this to you already. Ending units will be valued at $1,100, and then application of FIFO method. This also I have explained to you. What you need to do is, the later purchases will be included in your ending inventory. 10 units out of purchase 3, that was at $28 per unit. That comes to $280, and 40 units out of the last purchase, that was at $30 per unit, that comes to $1,200. Aggregate comes to $1,480. So please write up this whole thing, and that will be the end of the solution for this example. Alright friends, let us try to move ahead now. We will say that another example for application of matching principle can be taken as goods that are sold with a warranty. Now let me first explain something to you in respect of goods sold under warranty. See what happens. When you have made sales of goods along with warranty, and suppose the warranty period is 2 years, sale is happening now, but the customer has 2 years time. Anything going wrong with the product, any manufacturing defect found in the product over these 2 years from the date of purchase, customer has the right to come back, get that thing repaired or replaced as the case may be, depending upon the severity of the case, and the entity will have to incur cost towards that warranty because the product was sold under warranty. Any kind of warranty given along with the sale, the question arises, how would you recognize the revenue? If you can recollect, while learning the revenue recognition criteria, I have already explained to you that when goods are sold under warranty, the entire amount of revenue from sale should be recognized, but the entity needs to create a provision for warranties. The provision for warranty will have to be on the basis of the past experience of what kind of cost the entity might have to incur for fulfilling its promises under the warranty. So what will happen, cost may be incurred later with respect to warranty, but the sale has been recognized now. As a result, a provision should be recognized now. That provision will have an effect of recording an expense in the income statement in the current period, and simultaneously a liability in the balance sheet towards provision for warranties. Then when the company is actually incurring cost for its warranties given, then it is as good as paying off its liability, because liability has been recognized right away along with the recognition of expense towards warranty provision. So keep in mind one thing, and you should also understand same kind of treatment will happen even with respect to bad debts. Now what are bad debts? Entities selling goods on credit and customers do not pay finally. If a customer has made a default, not making the payment, we call that as a bad debt. Now what happens? Suppose in the current accounting period a sale is made on credit. So revenue has been recognized in the current accounting period, and in the next accounting period when there was a due date for payment by the customer, customer made a default in the payment, customer did not make the payment. If customer did not make the payment in the next accounting period, the bad debt loss will be recorded in the next accounting period, and this defies the matching concept. Correct? Revenue is recorded in first year and bad debt losses are recorded in second year, whereas the bad debt losses were pertaining to the same sale of goods. Therefore, even when you are having sale of goods on credit, you need to make a provision, just like you make a provision for warranties, you make a provision for doubtful debts. Now keep in mind one thing, provision for warranty is recognized as a liability, whereas provision for doubtful debt is not your liability, it should be placed in the balance sheet as a reduction from the amount of debtors. So suppose your debtors are $80,000 and you have made a provision of $2,000 as doubtful debt provision, then while presenting the balance sheet, the amount of $2,000 should be reduced from $80,000 and the net debtors balance should be disclosed as $78,000. On the other side, if it is a warranty provision, the warranty provision will be disclosed as a liability in the balance sheet. Now keep in mind one thing, the balance sheet effect kept aside, but the expense treatment will be same. That means whether it is provision for doubtful debt or provision for warranty, both will be shown as an expense for the current period where such provision is recognized. So keep in mind one thing, right now our focus is not the balance sheet components, right? Our focus point is income statement. So I am putting more emphasis on what happens in the statement of profit or loss or what happens in the income statement. Later when we deal with the balance sheet items, I'll be focusing more on each component of balance sheet later. So let us do one thing, let us write up these notes over here. So please write, the estimated cost of repairing or replacing faulty goods under warranty must be estimated and deducted from the revenue at the time of sale rather than when actual costs are incurred. This is achieved by recognizing the revenue from sales in entirety and then recognizing a provision for warranty as a liability and expense in the period in which the corresponding revenue from sales is recognized. Just make a note that similar treatment is required for bad debt losses as well. So please write up this whole thing and then I take you ahead. Alright friends, I am sure you have completed writing this whole thing. Now this was the whole discussion that we wanted for the matching principle or the matching concept in accounting. But as I said earlier, there are two additional methods that you need to consider. One is about period cost or expenses which are periodic, expenses which you cannot relate with your production. I gave you examples and I have in fact explained you the whole thing earlier already. Let me help you recollect that. You remember I gave you example of manufacturing this kind of remote control. The material cost for this is a product cost and matching principle will apply to that. But do you also recollect I gave you example of the rent of the factory building, where rent has nothing to do with how many units you produce. Rent is a periodic cost and will be treated accordingly. So that rent will be charged off as an expense in the statement of income or statement of profit or loss because it is periodic by nature. Similarly, expenses like interest, expenses like administrative staff salary or any kind of fixed expense where it is not related to the product directly will be considered as period cost and the best treatment for period cost will be as and when it is spent, you relate that with the period rather than the product. That means when it is incurred, it will be recognized as expense. Even advertisement cost, sales promotion expenses come in this category. When you have incurred advertisement cost, it is for that period, you charge it off. Now you cannot apply a judgment that if you have made advertisement expenditure today, the benefit of that expenditure, how long it can go. You cannot trace the period of that benefit, and therefore these expenses will be recognized as expense as and when incurred. So let us write some notes about these expenses as well. Recognizing the expenses as and when incurred. Not all expense can be directly tied to revenue recognition or revenue generation. These costs are known as period costs. Period costs such as administrative costs are expensed in the period incurred. For example, if a firm has occupied a leased premise, then the rent for the period under reporting should be expensed to the income statement regardless of revenue generated. Other examples can be salaries of administrative staff, insurance, depreciation of corporate office building, etc. So let's do one thing. Let me give you a chance to write down these notes and then we move ahead. Alright friends, now once you have completed writing this much, we go to the last segment of our discussion, that will be with respect to the capitalization method. Now this will be the last method with respect to recognition of expenses. Capitalization. Certain expenses are expenses, but they are not taken to income statement. Instead they are taken to balance sheet, because these are either capital expenditure directly, or they are expenses which need to be capitalized or which need to be included as a part of the cost of asset rather than cost of goods. Then these are capitalized expenditures, or this method is considered as method of capitalization. Now the whole discussion about capitalization is quite long, and what I will do is I will break this second lecture into two parts. So first part I'll be putting an end now after giving you a short note on capitalization process, and the whole discussion on the capitalization versus expensing I'll be putting on the second part of this lecture. So let's write some notes about capitalization process in general, and then we put an end to this first part. So please write under the heading capitalization of expenditure. Capitalization is an application of the matching principle whereby costs are initially capitalized as assets in the balance sheet and then expensed using depreciation or amortization to the income statement over the asset's life as its benefits are consumed. Property, plant and equipment and intangible assets with finite lives are examples of this. An accounting policy that recognizes expense later rather than sooner is seen as aggressive, while a policy that recognizes expense earlier is conservative. Expensing is more conservative than capitalization. I would want you to write up this whole thing first, and then the last paragraph over here I'll just provide a brief explanation once you have finished writing this whole thing. Alright friends, once you have written this whole thing, the initial part I have explained to you. That last paragraph needs some discussion over here. Let me provide some explanation with respect to that. See, what is being conservative? If you have made an expenditure and you record that expenditure in that same period, it is being conservative. Means you are not putting any asset into picture. You are believing that whatever I have spent is my expense, and I am charging off that as an expense in my income statement, which will directly reduce my net income or profit for the period. This is being conservative. So the process of expensing any expenditure you have incurred, you charge it off as an expense in the same period, is an conservative approach. It's a conservative approach. On the other side, if you are capitalizing an expenditure, as if you will put that expenditure in the balance sheet now, and later years you will amortize it over the period, gradually you will charge off the expense. You know what will be the impact in the first year's profit? initially when you are capitalizing that expenditure, your profit in the first year increases substantially because you did not charge off that whole expense in the statement of profit or loss or in the income statement. You have recognized that as an asset in the balance sheet. This is more of an aggressive approach. So the capitalization process or the capitalization approach is an aggressive approach, whereas expensing out any expenditure is a conservative approach. So expensing is more conservative as compared to capitalization. So as we have already written this whole thing, and I told you I am going to have detailed discussion on this whole concept of capitalization versus expensing in the later part. So the complete clarity you will be getting when you are watching the second part of this lecture. So with this note, I will be putting an end to this session. Thank you very much.